And great.
Yeah, so I'll share this. Alrighty, if you are currently on, just hang tight a little bit while we wait for some more attendees to flow through, and then we'll get started. We'll give it about another minute or two and we'll get started. All righty. Thanks everyone for joining us today for Net Impact's Sustainable Investing Landscape webinar. Before we jump in, I'll just run through the agenda. So I will, first we'll start off with introductions. We'll introduce Net Impact, who we are, what we do. I'll introduce our panelists. Our panelists will present for about 10 minutes each. We'll do some moderated Q&A. And then for the last 15 minutes or so, from 12 to 12:15, if you can stay on, we'll do a Q&A. So if you have questions, feel free to send them through the Q&A chat throughout the duration of the call, and then we'll start to get those answered towards the end, and then we'll conclude and talk about what we have going on upcoming. We also have some polls I will send out to engage with the audience, but from there, Nurul, I will pass it off to you.
Hello, welcome everybody. This is Nurul Yousafzai, also part of the Net Impact Chicago Professional Chapter Leadership. We're part of the Global Net Impact Network, which has chapters in various cities all over the world, as well as many colleges and universities, mostly, but not limited to business schools. And there are even company chapters that are within company. And so basically equipping leaders to build a more just and sustainable world. And that can be in business, public life, as well as volunteering and nonprofits and hybrid organizations. So in the Chicago chapter, we strive to build an inclusive community focused on social, environmental, civic, and business issues with people who want to grow professionally and personally. And we do this a number of ways. For all career stages, we're industry agnostic. Our events have traditionally been in person, but like everybody else, we've gone to virtual, but we hope later on this year to be in person again. And we've beefed up our digital channels. We have a newsletter every 2 months that mirrors blog posts as well as social media channels. So a little bit more about us. We've got over 700 people on our email list. We've got a paid membership tier that any professional is welcome to join, but you don't have to be a member to take advantage of most of our programming and events. We've got 5 board members and active volunteers at any given point from 2 to 7 people. And we are actively looking for additional people to volunteer. So if issues of environmental, social, governance, equity, and intersection of business and doing good and doing well appeal to you, definitely contact us. There's many ways to contact us through our website. We've got a web form, and we're on all the standard social media channels. We've also in the last year set up a Vimeo channel for past videos. That there's a link to that in our homepage, and this event will be uploaded within a couple of weeks to our Vimeo channel as well. So if you missed this or want to see a replay or want to tell your teammates about this video, there's an opportunity to do that. Thanks, Ed. Back to you.
Thank you, Neural. And my name is Ed Byrne. I'm a board member of the Net Impact leadership team. I'll be moderating the panel today. And I'm really excited to do so because my very first Net Impact event was actually an impact investing forum. So it's exciting to see all the growth that's been had in the space. But with that said, we still think that there's room for growth, especially given that the retail investor has kind of been left out of the equation. So today our goal is to learn from our panelists a bit about how ESG works, the different acronyms and buzzwords, as well as how it's practical to you. And then we'll touch on some of the career opportunities and of course the impact on society and the environment that we can have. So without further ado, I will introduce our panelists. Our first panelist is Sylvia Panek. Sylvia is an investment advisor and financial planner at Natural Investments. Sylvia has worked in responsible investing for 15 years. She started at Green America and continued her career with USIF, which is the Forum for Sustainable and Responsible Investing. After more than a decade of educating and advancing responsible investing, she joined Natural Investments in her current role as an advisor. Sylvia is also on the board of 350 Chicago, a climate change organization focused on divestment from fossil fuel companies by both institutional and individual investors. She also participates on the board for Invest Microfinance, a domestic fund extending microfinance programs to develop sustainable and socially just economies in developing countries. Sylvia holds a sustainability MBA from Marylhurst University and also happened to be a panelist on that impact investing forum I was talking about earlier. So excited to have Sylvia. Our second panelist is Dan Nielsen. Dan is the head of product management for ESG indexes at Morningstar, where he leads ESG index product strategy. He's been focused on sustainable investing since 2005. And before joining Morningstar, Dan was a managing director at Great Lakes Advisors, overseeing responsible investing and ESG integration. He's held previous roles as a director of socially responsible investing at Christian Brothers Investment Services and led shareholder advocacy for a $16 billion pension fund at Westpath. Dan serves as on the advisory board of the CEO Investor Forum and on the Leadership Council of Loyola University Baumhart Center for Social Enterprise and Responsibility. Dan holds an MBA from University of Chicago Booth and also is an adjunct professor at Loyola's Quinlan School of Business, where he teaches ESG investing. So I will go ahead and hand it off to you, Sylvia.
Great. Thank you, Ed, for that nice introduction. I didn't realize that when we met, it had been your first Net Impact meeting, so that's nice to know. You guys, the Net Impact chapter is a really great group, and I've enjoyed going to the events over the past couple of years. So, but with that, let me share my screen, and we'll kind of go into talking about what is ESG and all these acronyms and everything. Let's see, presentation mode. Thank you. Excellent. So, some of the basics. SRI. It can be referred to as socially responsible investing. It can be referred to as sustainable responsible investing. I've also heard it sustainable responsible impact investing. So generally at Natural Investments, we consider it to be in like 3 different groups. Corporate screening and shareholder action, first circle on the left. If you go down to the bottom, there's the high impact, sustainable and socially responsible investing that's done in another circle. And then there's community development finance, domestic, international, microcredit and lending and all of that. Generally, these different acronyms, corporate screening and shareholder action happens in the publicly traded market. The private market is where you tend to get high impact going to investing privately into social enterprises, right? Or direct companies, working only on, let's say, environmental solutions or social equity. And then the final section, banking and lending, completes the sort of 3 areas that Natural Investments looks at when we manage our clients' assets. For today's presentation now, ESG, environmental, E, S is social, G is governance, corporate governance issues, tends to be long in the public and the private market. However, I think for today, we're going to focus mostly on talking about how it applies in the public market because it is the lion's share of the investment world happens in the public market. So a little bit about how SRI and ESG has evolved. In the beginning, it was really negative screening, and it tended to come from religious groups who would have things that would be against their faith. So in Catholics, Christian faiths, it tends to be no alcohol, no tobacco. Quakers, nothing that proliferates war. Jewish Islamic faiths, also no alcohol or no pork or milk or usury sort of lending at high interest rates would be something that you would not invest in. In modern times, back in about the early 70s, negative screening also took the form of anti-nuclear proliferation and not investing in those and creating funds and investments that didn't contribute to the nuclear crisis that was happening, or what seemed like the nuclear crisis that was developing. Then eventually it evolved into also positive screening, best in class, looking at a particular business or sector and saying, okay, who's doing this in the most responsible, least environmentally destructive way? This sort of peer-to-peer comparison approach. Eventually, thematic types of investments came out, gender lens, fossil-free funds, labor equity funds, water conservation funds that would focus on a particular niche area. ESG integration, I think, is this next sort of evolution of having this sort of in tandem with financial analysis using ESG metrics. And Dan Nielsen is going to go more into that. So I'm not really going to answer very many questions, And then the final part, impact investing, that really belongs in the private space, but I wanted to give it some credit here where any sort of investments that you're doing, you're really looking at the end goal needs to be a positive environmental or social outcome. And that's why you're investing in it. So something to remind you is that this can be a blended approach. You don't have to use only one in your portfolio, is what is possible. A little bit about the trends that we've seen. US Fifth Foundation puts out a report every 2 years. And, the past 25 years, it's phenomenal growth. There was a tipping point right around the beginning of the 2010s where it's just almost like exponential. Over the past 2 years, between 2018 and 2020, there was a 42% increase. So now it's about $17 trillion in the US. Has some sort of ESG criteria applied to it. So that's in context, it's about 1 in every $3 in the US has some sort of socially sustainable, responsible component to it. I thought that this would be a little good snapshot of, we're not really going to get too much into shareholder advocacy, but publicly traded companies do have accountability to their shareholders to have an annual meeting, and shareholders are allowed to vote on the board of directors. And there's also the possibility that other resolutions will be put forward by management or shareholders. And so shareholders are allowed to file under certain criteria and ask for information. So some of these themes that we're seeing, the proposals that are filed, climate change, the third one is the big E, environmental one. Then there tends to be a lot of labor or human rights issues that get filed in the sort of F category. But resolutions also focus a lot on governance, good governance. So political spending, what kind of political spending is being done, CEO pay, say on pay resolutions, board diversity, proxy access, etc. Wanted to give you a little flavor of what that looks like. And then before Dan really gets into the meatiness of how to incorporate ESG in financial analysis and the trends that have been happening, I thought I'd give you a couple of resources to kind of do it yourself and educate yourself if this is still a new area of finance to you, where you can learn and or ask your advisor. And I'll also put this in the chat so you don't need to copy. But here's also a little disclosure screen that I need to give. So I think I ran through it maybe a little bit quickly, but Dan, I think I saw your presentation and I was like, you need a lot of time to go over all of that. So.
Thank you, Sylvia. And Dan, we can pass it off to you.
Great. There we go. Can you see my screen? Excellent. So Sylvia talked about some of the trends as far as the amount of asset flows into sustainable or ESG strategies. I think what's really important to point out from Sylvia's graph is that inflection point around 2010, 2012. I believe one of the big drivers that created that sort of, hockey stick, upward slope is the prevalence of ESG data and research, and the adoption of that by more and more asset managers because they see it as adding value to their investment decision-making process. We can see on the slide here, what I've done is depicted, these are just mutual funds and ETFs. So you see the numbers a little different than what Sylvia talked about, which was all assets with a sustainability component to its strategy. But similar to Sylvia's graph, you can see the rapid growth here. Particularly quarter on quarter, and the amount of assets that are flowing into sustainable ESG mutual funds or sustainable ETFs, exchange traded funds. So in addition to the amount of assets, the number of funds themselves have also been skyrocketing. And it's really a chicken or egg in the sense that more funds are being created because there's increasing interest amongst investors, and they're chasing those increasing interest, those dollars. So you can see just at the last quarter of last year, asset flows increased by 88% compared to the previous quarter. So one thing that's also talked about a lot is not just the asset flows, but the performance of sustainable funds. And this is an analysis that one of my colleagues here at Morningstar has conducted. And what they've done is they've created criteria to designate which investment funds are sustainable funds and which aren't. And what they do is then they look at the performance of the sustainable funds in each asset class versus non-sustainable funds, looking at performance numbers. And you can see here, the 4 bars represent actual investment return performance, the top quartile across the top, and then down to the bottom quartile, the bottom 25%. And what's obvious here is that 45% of all the mutual funds that Morningstar designates as sustainable mutual funds, 45% of those performed in the top quartile of fund performance. And only 9% of funds that were designated as sustainable investment funds were in the bottom quartile. So again, this is just over a 2-year period, and performance does vary over time, but based on this 24-month assessment, there's definitely a strong trend towards sustainable funds helping to contribute to positive performance. There we go. Many of you might be familiar with Milton Friedman and his famous quote that there is only one social responsibility of business: to use its resources and engage in activities designed to increase its profits. So that has come down to with a lot of criticism, because it tends to be interpreted as companies should be focused just on maximizing profits and have a very narrow focus on that, to the exclusion of everything else, including other stakeholders, employees, local communities, the environment, etc. And that's come under some attack lately over the past couple of years, with people promoting an expanded sense of what the responsibility of companies should be. For instance, Jamie Dimon, the chair and CEO of JP Morgan Chase, says major employers are investing in their workers and communities because they know it is the only way to be successful over the long term. And the Davos conference came out with a manifesto in 2020. The purpose of a company is to engage all its stakeholders in shared and sustained value creation. And I think an important designation here that gets lost with Milton Friedman is the time frame. And the focus here is really on what's going to create long-term sustainable value within companies, and what things need to be managed at companies in order to achieve that. So a focus away from short-term quarterly investment returns, quarterly profits, and really looking at how can we sustain revenue growth and value creation over the long term. So Sylvia shared her 3-circle graphic. This is my version. I think one of the things I try to highlight is not just the strategies, but what are the intentions? What are the goals of investors? What are they trying to achieve? As Sylvia talked about, the exclusionary screens used a lot by, say, religious investors. Their goal is not to try to improve investment performance by excluding certain companies or companies involved in certain activities. Rather, it's aligning those investments with their values, with their beliefs, so that they're not actively benefiting from an activity that the company is engaging in that they disagree with. And so the investor isn't actively contributing money to the company so the company can pursue those activities. So the goal for that first bucket is values alignment. And this isn't just with religious investors. It can be any investor across whatever issues you're concerned about. But again, the primary purpose is values alignment, or ethical investing. The second category here can be defined somewhat narrowly as ESG integration. What is relevant to the financial performance of companies? So it's looking at a very narrow lens, and unlike the first bucket where it's about values alignment, the second bucket is primarily focused on an investment thesis. That if you invest in companies that are doing a better job managing material ESG risks and pursuing material ESG opportunities, the thesis is those are going to make better investments. And then the third category here is wanting to try to achieve a positive incremental impact, either through thematic investment strategies like gender lens investing, or impact strategies that are creating, again, that incremental positive impact, either on the environment or with society. So the goal for impact investing really is to generate a financial return in addition to some sort of social or environmental return. So focusing on that second bucket, ESG integration, there's really 3 steps in integrating that into the investment process. The first step is a materiality assessment. So identifying for each company, what are the relevant issues that are likely to impact its ability to create value? So what are the issues that will likely impact investment returns? Those issues are going to be different for every company and across industries. So as you can imagine, environmental concerns and managing climate risk is going to look very different at a company like ExxonMobil than it will at a company like Microsoft. So the first step is understanding which issues are relevant and which aren't. Because if your primary goal is to improve risk-adjusted returns, you don't want to think about issues that are not relevant to achieving that goal. So the materiality assessment, what issues are relevant? And then next is, after you've identified that, how is the company actually performing on those issues? So there's really 2 different comparative analyses that are important to do here. One is, what's the relative performance of the company compared to its peers? So is the company doing better than its competition on these relevant ESG issues that will affect its financial performance? And then the second one is, what's the trend over time? Is the company improving its performance on relevant ESG issues, or is it getting worse? So that trend line is also really, really important. And really what we're trying to do is assess, what is the impact on the company's performance by conducting this analysis. And that's going to identify what issues are relevant, assessing risk, and trying to identify, does the company have a competitive advantage relative to its peers? So as an example for competitive advantage, compare 2 companies like, say, Kellogg's and General Mills. They both make cereal. They both have very large agricultural supply chains. If one company is more efficient in its water use than the other company, that company has a competitive advantage. And if there's a severe climate event, if there's a drought or floods, et cetera, the company that has a competitive advantage doesn't have to raise prices or cut into margins, the same as a company where they're not as efficient. So as an investment analyst, trying to identify what companies have a competitive advantage will help us make smarter, better investment decisions. So one of the frameworks that's good to be aware of to help us identify which issues are relevant is from the Sustainability Accounting Standards Board. You can go to their website, sasb.org. You'll see they just merged with another organization. So their new name is a Value Reporting Foundation. But SASB.org will take you to resources that SASB developed, including this, which is a materiality map. And you can see across the top in the black row, there's 11 different industry groups. And boxes are shaded depending upon how relevant the issue is to that industry group. Dark, very, very relevant. Light gray, medium relevancy. And white, obviously, the SASB framework says it's not as relevant to financial performance. And here we can do a little bit of a comparison. So looking at this, so you see there's 5 across the left, there's 5 categories of issues. And then SASB has gone down and broken them into different sub-issues within those categories. And here you can see a comparison between the airlines industry, telecommunications industry, and electric utilities. And you can see some commonalities across these different industries, but also you see some big differences. And this is why it's really important to do that materiality assessment, because you only want to focus on those issues that are relevant to the company's financial success. So after identifying those issues and looking at a company's performance on them, it's important to understand how those issues will affect the company's success. So if you see in sort of the middle bottom financial impacts, these are some of the ways that a company's performance on ESG issues will affect its success, whether it increases or decreases revenues, whether it increases costs, or if you're investing in more efficient equipment, it can reduce costs. It could affect your cost of capital. So how much does it cost a company to borrow money to invest in itself and try to create more value? A riskier company will have to pay more in interest to borrow money. And finally, assets and liabilities. So if there's a company that has hard assets, let's say factories, if it's located in an area that is subject to severe climate change risks, that could impair the value of those assets. So Ed, that's what I had prepared to share. So I'll hand it back to you. Thanks.
Awesome. Thank you, Dan, and thank you, Sylvia. And thanks to the audience for filling out that poll. So the question was, what level of familiarity do you have with ESG/sustainable investing? And the majority vote was, I am familiar, but do not invest in ESG currently. So I think that is a good segue into my first question. Can you tell us how an individual investor would go about finding or building out a sustainable portfolio, whether that's an ESG fund or a thematic fund? Are there any tools or due diligence methodologies that you would suggest?
Sylvia, do you want to jump in first?
Sorry, sure. I had to unmute myself. It really, from what we've seen, depends. There could be funds and portfolio managers where they build the tools in-house, and they take the metrics and they develop their own scores, their own methodology, their own assessment and analysis to incorporate into decision making. Others may rely on third-party data, such as MSCI, Sustainalytics, or some others that are out there, Morningstar as well. And then they could do both, in-house, out-of-house, third-party research, and so it just really kind of depends on how they want to go about it, how big the fund is, can they do it themselves and hire the team? Do they want to separate general analysts from, or have special ESG only? So it can be the whole spectrum from what I've seen.
And for retail investors, they typically invest in mutual funds or ETFs. And there's some resources at Morningstar's website where you can see a sustainability evaluation of more than 20,000 mutual funds and ETFs. And for those of you who may be familiar with Morningstar, that one of the things they're best known for is the star ratings that they give mutual funds. So 1 to 5 stars, and that's based on an assessment of the mutual funds' financial performance, investment performance over time. What Morningstar has done is it's developed globe ratings. So in addition to the stars, it will assign each mutual fund 1 to 5 globes based on the ESG scores of the companies within the mutual fund. So one way to identify which mutual funds have a strong sustainability component is to check out the globe ratings. Another thing Morningstar just recently launched is an assessment of mutual fund managers' intentionality. So are they actively trying to incorporate sustainability into their investment process, or is it just coincidental that they have sustainable companies and they have a 5 globe rating? So I think both components are important to understand when selecting mutual funds when you're concerned about sustainability.
Sure. Thank you, Dan. Thank you, Sylvia. And then my next question is around incentives. I feel like with the proliferation of ESG, sustainable investing, how has it been kind of reshaping the ways that companies are actually, running their businesses? That's for either of you.
Well, I think two ways are, one, especially with the promulgation of SASB and the materiality framework, that was actually developed in conjunction with companies, not just investors. And the goal was to make sure that what they identify is relevant to companies as well as investment analysts. So what companies can more easily do now is identify what issues can create value and what are some of the metrics that they might use to measure performance over time. So it's provided a good set of issues to help companies focus on what's important and what's not. And I think what primarily what you've seen in some of the asset flow graphs that Sylvia and I shared is the size of assets that are flowing into sustainable funds now has gotten the attention of companies, to the extent that they recognize that sometimes investment decisions are made in part based on their ESG or sustainability performance. And therefore, they've started communicating much more effectively what that performance is to investors. So it's not just in a corporate sustainability report, but it's within the context of what's relevant to investors. And we need to make sure they have the information they need so they can make a well-informed decision. And hopefully that would mean investing in our company.
Got it.
I would also say that this asking of information on ESG issues from investors, companies in the beginning may not have been looking at certain issues like their waste management as closely, but when they keep getting these requests to see how are you, let's say, dealing with your waste in sort of like environmental pollution supply chain, what gets measured, matters, that sort of thing. It would then turn around and they'd get a better idea of how they compare to their peers. What does this mean? How much is this costing them? How is this going to hurt and make them look bad if they have more waste than their peers do? So it has, I think, sort of increased this focus in areas that maybe previously companies wouldn't necessarily put as much attention to. They focus more on value creation for the customers, for the products, right, for services that they're offering. So there has been positive, I think, net positive social and environmental value that's been added to it.
Sure. And I know we've been talking a lot about equities, but can you tell us a bit about the fixed income market when it comes to sustainable investing, specifically green bonds? I've heard that municipal bonds can be used for some serious, impact. I've also heard of blue bonds. Can you just give me maybe the rundown of what it looks like from a fixed income perspective?
Bonds are, they're loans. It's not really like the share price will rise or fall depending on you investing in them. So it's a different market. With the green bonds, I think, especially with, let's say, fossil fuel companies, right? They're seeing a lot of divestment from their companies, right? People who don't want what's happening with climate change on a global scale. And it's been easier if they can issue a green bond that says the money that you give to us will only go towards renewable energy infrastructure and projects. That's been a way to sort of incentivize them to change their business model as opposed to completely letting go of the fossil fuels. And so it's been a way to have this sort of carrot and stick approach to the transition. So with blue bonds, I'm not so familiar with them. I'm more familiar with the green bond space. Dan, I don't know if you have anything to add to that.
So it's with green bonds and blue bonds, it's really about the use of the proceeds. So if the company is borrowing money and they're marketing the bond issuance as a green bond, that means that they're going to use those proceeds for an environmentally friendly strategy or initiative. So say, Toyota could issue a green bond in order to put solar panels on top of its manufacturing plants. Blue bonds focuses on ocean type issues. So whether that's cleaning up plastics or reducing water pollution discharge, et cetera. But again, it's the use of proceeds. And in that way, it helps investors align with doing good, as Sylvia talked about, that having that positive impact.
Sure. And next, I want to, before we kind of talk about some career stuff, I want to talk about impact. So I know a few weeks ago, a hedge fund had led a shareholder advocacy rebellion, I guess you could call it, with ExxonMobil, where they nominated 3 new board members. They were elected. They're a little bit more socially responsible. So we see the power that, you know, a big Wall Street bank can have. Can individual investors have that same kind of effect, or is that more so something that's for accredited investors or bigger hedge funds?
I think it's sort of like voting in elections. You know, one individual vote may or may not affect the overall outcome, but if everybody votes, it will have an important impact. It's the same thing with voting proxy ballots. So these are ballots that companies put out for their annual meeting, and any shareholder in a company that owns stock will receive a proxy ballot and be able to vote on different issues. The most common one is the election or re-election of boards of directors, you know, the actual director candidates. But it's also possible for investors to file shareholder proposals. So instead of ones that management includes on the proxy ballot, a shareholder can submit one on an issue they feel is really important to the company and its success. And what we're seeing is more and more shareholder proposals getting the attention of companies, and companies actually adopting certain new practices, whether it's a new policy or changing part of their strategy in response to shareholder requests. In fact, over the past 3 years, half of shareholder proposals that were filed were actually withdrawn. And that's because when a company receives a shareholder proposal, they are more likely now than in the past to want to negotiate with the shareholder, to try to engage, to try to understand what is the concern that the shareholder has, what steps can I take as a company to address those concerns so that the shareholder proposal doesn't come up for a vote. I'm going to share something. You mentioned ExxonMobil.
Yeah.
So there's a small hedge fund called Engine Number One. As Ed said, they submitted some alternative board candidates that they argued had climate change experience that didn't exist on ExxonMobil's board. And what was really remarkable about this, and this happened just right at the end of May, is that 3 of the 4 candidates got enough votes to join ExxonMobil's board. So they displaced 3 of the incumbent board candidates that the management nominated. And why this is really, really important, and you can see the number of votes. I mean, we're talking 1.5 billion votes for the different candidates in order to get elected. Some of the big mutual fund companies like BlackRock or Fidelity or State Street or Vanguard, they are now starting to vote in favor of shareholder proposals. And they have so much of concentration of ownership in the companies that they can influence votes so that, you know, shareholder proposals and here, you know, election of directors, they actually win. So what's also interesting is there's a number of other shareholder proposals that were on at ExxonMobil. And in addition to the board candidates, 3 of them winning a seat, 2 shareholder proposals also got a majority support from shareholders. One, a report on lobbying activities, so think political lobbying, and then a report specifically on climate-related lobbying. And the real thrust here is making sure that, in this case, ExxonMobil's actions, their lobbying activities, are in alignment with what ExxonMobil actually says it's doing and what it's trying to promote by way the last shareholder proposal here dealing with climate change. And it's really holding companies accountable so that they walk the talk. They can't get by with just saying that they really want climate change addressed, but their lobbying money is actually going against trying to create regulations and rules to improve climate.
Can I jump in with just some information? I didn't realize it until years later, but in high school, I remember seeing some sort of like Dateline or 60 Minutes report on Catholic nuns that were submitting climate change related proposal at ExxonMobil. So shareholder proposal, this sort of ESG proposal activity has been going on at Exxon in particular in this case for about 2-3 decades. Shareholder resolutions are kind of like New Year's resolutions. It's sort of a declaration, a signal, and asking for information, but it's non-binding. So just because that climate lobbying proposal received 64% majority favored and the majority vote from the shareholders doesn't mean that Exxon needs to do anything. And, after receiving climate-related resolutions for nearly 30 years, ExxonMobil hadn't really been changing its behavior. So these resolutions are non-binding. They're really more like signals and asking of information. But it doesn't mean that the company needs to do anything. So this is why I think Engine Fund, the hedge fund, stepped in to have it was an $80 million proxy battle with ExxonMobil. It was about $40 million on each side. Engine One had to spend the money to create its own proxy ballot that it could submit with its own nominees, and then send them out to shareholders for them to vote on. And then the voting, is compared to who got more votes. And this was a bit of a historic proxy battle. It hadn't really happened before, which is why it's kind of been in the news, because it's not very often that an institutional investor or hedge fund will be willing to spend that kind of money to go against management, that they're so unhappy with ExxonMobil's management that they were going to go into this, and they could have lost. They could have not gotten any of their nominees onto the board, and it would have been $40 million out of their pocket. So this is why kind of it's been a really big item in the news lately in the investor world.
Certainly. And so it seems like sustainable investing is driving a lot of innovation, not just from how companies operate, but also how the financial products are structured. And Dan, I'll ask this to you. Are there any either funds or ETFs that are coming on the horizon where essentially when you buy shares of them, when you buy the ETF or the fund, that they're going to be voting in a certain way with the companies that they own in regards to proxy voting?
So yes. So every mutual fund is required to disclose how it votes its proxies. And the deadline is August 31st of every year. It's a filing with the federal government that becomes public. So it's very easy to look at how a mutual fund has voted on, say, in this case, shareholder proposals and evaluate them. And I think what we're seeing, it's demonstrated by the ExxonMobil results, is more mutual funds are recognizing that there is a strong investment case for supporting certain shareholder proposals. And therefore, they want to vote in favor of those. And in particular with ExxonMobil and the election of 3 directors, as Sylvia explained, there have been climate-related shareholder proposals being filed at ExxonMobil for decades. And I think one of the strong rationales behind firms like BlackRock or Fidelity or State Street voting in favor of these 3 dissident candidates is because ExxonMobil has not been responsive to the shareholder proposals. So even if they get a majority support, as Sylvia explained, the company is not obligated to implement it. And if the company is not being responsive, even when shareholder proposals are getting such a large percentage of support, really the only recourse then is to change the membership of the board.
Got it. And now we'll pivot a bit to career. So both of you have been doing this before ESG was really a ubiquitous kind of household acronym. What is it like to work in the industry, and more so, obviously we talked about ESG, sustainable investing, impact investing. What are the different types of ways somebody can be involved in this work if they were to want to be a career changer?
It really depends on what interests you the most. So as I showed in the very beginning, it's not just publicly traded, companies and mutual funds and ETFs. There's also the private sector, private investment, impact investing funds. There's banking, lending, community development institutions, microfinance. It's what interests you, where you have your passion, and there's ways to get your foot in the door, even if you are in an NGO on human rights, right? You could go and take that information that you have and become an analyst at either a fund company or a research firm to help them analyze companies and how their impact might have in communities, right? Where there might be human rights violations, mining in the Democratic Republic of the Congo, right? Or sweatshop labor issues, right? Let's say in Southeast Asia or something like that. That insight that you have would be valuable to them. So you could go and use that information. You could become a program director for shareholder advocacy and shareholder resolutions, filing resolutions at a fund. It could be a religious institution on human rights issues. So there's different ways of being able to use your passion, knowledge, in whatever career you are now, if you're not in it, to then enter the space and add what you know and contribute.
Sure.
So as certainly at investment management firms, there are a number of roles that touch on sustainability and ESG, from being an investment analyst and evaluating ESG issues alongside non-ESG issues when researching companies and making buy and sell decisions, to working with clients, either in business development or client relations, clients who are interested in sustainability, but may not have a deep knowledge of that. So providing that type of value to clients of an investment management firm is another way. Providing advice, whether it's as an individual financial advisor, working with individual investors, Sylvia, or also at an investment consulting firm that is working on how do they evaluate managers on sustainability, and then how do they work with institutional clients on whether or not they should pursue ESG and sustainability, and if so, in what ways and what asset classes.
Sure. And if somebody has never worked in finance, Dan, I know that you were the first in the first cohort of the FSA through SASB. Are there any credentials or classes or ways that somebody could build up their resume if they were looking to make the jump into sustainable investing of any sort that you would suggest?
Well, certainly being familiar with SASB is one way to do that. And Ed, the credential you reference is the Fundamentals of Sustainability Accounting. And that's a credential that SASB developed to help people understand the SASB framework, to assess what issues are material, how those issues can have a financial impact on companies, as we talked about before: revenues, cost of capital, actual cost, assets and liabilities. So check out SASB and look into the FSA credential. That's certainly one. I do feel like increasingly, if one is looking for a role on the investment side, at an investment manager, a portfolio manager, a mutual fund, then having some financial background is really important, because it's not enough to just know the ESG issues. Say, being an expert on human rights. It's being able to apply that knowledge within the framework of evaluating companies, evaluating investment opportunities and options, and being able to translate how human rights performance will impact investment returns. So it's not enough just to have that human rights experience. However, I would also say that it's not enough just to have that investment experience any longer, because the set of issues that are being identified as relevant to making smart investment decisions is a lot bigger now than it was 10 years ago. And
Sure.
Therefore, it's important to have knowledge of both areas and be able to bring that together.
Gotcha. Okay. I think I'm going to go ahead and jump into some audience Q&A. It looks like it's filling up pretty quickly here. So Tori Davidson, hi Tori. Big tech companies recently pushed back on calls for the SEC to mandate ESG disclosures and 10K filings. Is there a better way to require disclosure, Or are these tech companies who often include ESG labeled funds, or are these tech companies nervous about the transparency?
The only way to require it is through the federal agency, the SEC, right? There's no other way to require them to do anything. It's voluntary on their part, whether they want to or not. What you get with voluntary disclosure, though, which is pretty much how currently ESG information is collected, is that companies could be reporting in different ways and different amounts of information on different schedules. So there's this difficulty in doing an apples to apples comparison, let's say, when they get to choose what they disclose and how they disclose and when they disclose it. So having it be required, there is some then ease of also knowing, okay, well, this is what I need to do, getting all your ducks in a row, providing it on a certain time frame. I don't know. I would like it to be required, but obviously I'm understanding it can't just all be outlined. There probably needs to be a phase in because it would be a very big change, right, for them to have to gather all this information. And I think that's probably why they're pushing back, is that it would be a lot of work. It would, adding more team members and new tools and development to really track everything that's happening or that's being requested out of them.
I think a big component too is simply accountability. And if, in this case, tech companies are under a lot of scrutiny and a lot of criticism for some of its, more S-related activities or policies, think about, Facebook use, et cetera. If companies are under increasing scrutiny, then disclosing additional information will shine that spotlight even more on them. And companies tend not to want that sort of scrutiny. So there's an accountability issue. I do think mandating disclosure, one, it's tricky because, as we talked about with the SASB framework, different ESG issues are relevant to different industries and sub-industries. That's very different than financial performance disclosures, like what was developed in the early 70s in the United States with FASB, where it's very easy to do an apples to apples comparison, even with companies across different industries. So what does the balance sheet of ExxonMobil look like compared to the balance sheet of Microsoft? You can sort of see that, and it's more of a comparison. It's very hard to do that when you're evaluating ESG issues at ExxonMobil versus ESG issues at Microsoft. So it's trickier. There's more of a challenge because of this materiality component. But I think it's really, really important to set a level playing field and require a certain level of disclosure so that as an investor, I have the information I need to make good decisions and good comparisons.
Got it. Thank you. And thank you for that great question, Tori. I'm going to take another look at the Q&A. So Brenda Christopher is asking, on the topic of Engine One, they recently announced a new ETF where they intend to continue their activist approach, but allowing retail investors to get involved via ETF. Would love to. I think I kind of already answered that question or asked that question. Let's see what else we have. How have you best explained to investors to use quarterly results that ESG may have higher initial costs, but both lower costs and better returns long term? Does that question make sense?
You could argue that there may be, and I say may be, some incremental additional costs, because there may be additional data that you're licensing from a research vendor, or there may be an additional investment analysts that you need to help do ESG integration and implement that. My contention is that if that is being done within a materiality lens, so if the goal is to try to improve risk-adjusted returns, then it could be a worthwhile investment for companies, for investment managers, to incur this slightly incremental cost, because if it improves investment performance, then assets are going to flow into the strategy. They'll get more revenue, and hopefully that will offset any costs. As far as performance, again, if the focus is really on long-term financial performance, then that should also materialize. I mean, remember the slide that I showed about sustainability funds in each of the 4 quartiles of performance. Sustainability funds over the past 2 years, I thought it was 46% of them were in the top quartile. So success is going to breed more success. It's going to be followed by additional asset flows.
Got it. Do you think that ESG is a like integral part of analysis on funds if you're looking for return? Like, is there going to come a point where, like, if you're not using ESG integration, then you're going to be avoiding return? You're taking on too much risk.
I think that's kind of what we're already seeing, right? With the ESG space in the US being 1 out of every $3, and it looks like it's only going to keep growing. Applying ESG criteria to your financial analysis is just a more sophisticated way of looking at information, as opposed to just looking at like the balance sheet, right? And sort of like working capital ratios. You also need to include all this other information. Why would you ignore it if you have it available? So eventually it will probably stop referring to it as ESG integration. Everything is going to be ESG.
It'll just be investing. There won't be a distinction
Right.
between ESG or sustainability and non. And I think one of the things that's really feeding into that trend line on Sylvia's graph is more and more managers are pursuing ESG integration, even if their mutual fund or strategy is not labeled as ESG or sustainability. They're doing it because they think it will help them make smarter, more well-informed investment decisions. And as the availability of ESG data and research goes broader, and also the quality improves, and we have a longer history of that, more and more managers can see more clearly how it's adding value to their investment process, to their decision making. So it's not just the marketing and what the label is of the strategy, whether it's labeled as ESG or sustainability. It's just how can you make the best investment decision possible? And ESG is a contributing factor to that, increasingly so.
Mm-hmm.
Certainly.
And it's interesting that the SEC a couple of months ago announced that it's putting together a task force to evaluate when a mutual fund says it uses ESG or that it's green or what have you. Are they really doing that? To sort of like eliminate greenwashing or, using these labels in a way that's not really what's happening on the backside. So that's interesting to see.
Sure. Okay, and it looks like there's questions coming to the chat, so I'll look over here to. So I'm going to ask this long question. These are very interesting times as the narratives, issues and trends in SRI are both controversial and being debated between the failures and context bias, limits in practice, ongoing metric innovation, and challenging accuracy, in addition to the problem of optics over outcomes and evolving expectation being met by better, more just, relevant, competitive benchmarks, ratings, verification, and compliance design. The current surface dialogue is proof for better understanding the contract. Is that a question or just a statement? I think that's a statement. Neural, can you do me a favor and monitor the Q&A? If you see any good questions, just pop up and ask them. But I have a question. We were just talking about $1 in $3 going towards ESG oriented funds. Why is Europe so far ahead of us in sustainability, ESG investing? And what do we need to do to catch up with them?
I think there's a couple of things. One, there's more regulation in Europe addressing sustainable investing. And whether it's requirements, disclosures that investment managers have to report out on how they're doing ESG and not whether, that's certainly driving adoption of it. There have also been a number of very, very large asset owners, think pension funds in Europe, that have voluntarily decided that they're going to do ESG integration, responsible investing, sustainability. And the amount of assets from those asset owners is pushing more investment managers to do that. And it's sort of like a proof case where they're demonstrating that we can invest sustainably and still get good returns for our beneficiaries in the pension fund. And with that proof case, it's easier for additional investment managers and asset owners to pursue that. I think the last thing is different philosophies between, say, North America or the US in particular and Europe. I think the US tends to have a bit more of a libertarian approach to most things, whereas Europe has more of a willingness to accept regulations from the governments, et cetera. And for that reason, I think there's at least historically, there's been less willingness to have regulations that affect all investments here in the US. Rather, let every investment manager just do their own thing.
Got it. Okay, let's ask a question. How meaningful are and comprehensive are various ESG metrics, ratings, assessments in terms of reflecting holistic ESG impacts and trend lines? Are assessment methods always evolving? This sounds like a question a little bit about how data is aggregated on like the Sustainalytics level. Maybe Dan, if you want to touch on that a little bit.
Sure, I think it's important to point out that different ESG research vendors have different ESG methodologies. And what we saw demonstrated in one of the slides is the SASB framework. These are the issues that SASB has identified as relevant for each of, within 11 different sectors, 77 unique industries. The big ESG research vendors like MSCI, like Sustainalytics, they have different ESG integration methodologies. So they're going to look at different issues and they're going to weight those issues differently from each other. And it's up to an investment professional to do a comparison and decide which methodology makes the most sense or what components of each methodology is logical to them and incorporate that in. So there's no one right answer. It's really a difference of opinions. Both firms are going to, MSCI and Sustainalytics are going to say their methodology is better than the others. You'd expect to hear that, because they're trying to sell their ESG research. But as a consumer, it's important to understand the methodologies and then the quality of the information that's being fed into those methodologies.
Sure, that's helpful. Thank you, Dan. Do you want to add anything, Sylvia, or should I go to the next question?
I was thinking a part of the question was, how does this relate into impact? And I was going to say that the impact, it takes a long time. There's a bit of a lag, right, between the decision making, the actual investing, communicating with the company as to why you put them into your fund or why you're dropping them from your fund, and then having them turn around, improve, get back on your fund or on your list, right? And so it's a long-term thing. It's not usually a direct immediate impact in terms of the ESG impact that you might be saying. If you want more direct impact, I'd probably go into the private space, which is not usually available to retail investors because the government wants to make sure you're not putting lots of money into one thing. So usually you get more diversification and safety in the publicly traded market and ETFs and open-ended mutual funds.
Sure. And Sylvia, maybe that's a good segue. I was curious, so we've been talking a lot about different ways to use maybe Morningstar tools or do analysis so we can build out our own portfolio. When is it important to look to an advisor like yourself? Is it more like when you want to go into that more private space, or like when is it good to go say, okay, at this point I want to go and reach out to an advisor?
Mm-hmm. Usually, I would say once you start to get into the six figures in terms of how much assets you have. Anything less than that, usually, it's just a little bit, there's a lot of resources online. You can kind of do it yourself, and an advisor's fee will be eating away at your growth. And I feel like it's more important for you to it becomes more important to have an advisor when you have more to lose, right? Losing, if the market were to drop, 30%, losing 30% on $10,000 is very different than losing 30% on $500,000 or $1 million, right? So usually I think people can kind of do it themselves. But if you really, really don't know what you're doing and you're not comfortable with that, there is, because of technology and finance, developing robo-advising, where platforms, you kind of give them, you open the account there and they will do it for you. And there are a growing amount of ESG-related robo-advising services out there.
Sure.
So you don't have to do it yourself.
I would suggest too that if an investor is interested in sustainable investing and working with a financial advisor, it's important to do due diligence on the financial advisor. So how well does that financial advisor understand sustainable investing? How are they identifying which sustainable mutual funds, et cetera, might be good investment opportunities for their clients? There's certainly a challenge of investment advisors marketing themselves as having capabilities that may be somewhat thin. So just being a conscientious consumer when identifying a investment advisor and making sure that investment advisor has expertise in the areas that you want to pursue.
Yeah, that's a really good point, Dan. I know that greenwashing can certainly take place, and as demand grows, that's going to be something that advisors need to, or clients rather, need to be aware of. And by the way, for anyone who's joining us, I just sent out a poll. This is hopefully going to be our last virtual event. So if you can answer those questions about what you'd like to see coming up, we'd appreciate it. And then this is a pretty open-ended question. How do you see ESG investing playing a role in the post-COVID economic recovery? I guess,
I do know that during the pandemic, there were a lot of investors who were sending statements and engaging companies into making sure that, that they are trying to take care of their workers, not forcing them to come back early without proper, PPE and protocols in place, let's say, in like the restaurant hospitality industry. Looking at wages and accommodation and for childcare and school systems and remote working and all of that. So, that was a bit of a way that SRI-minded advisors and investors were doing it during the pandemic. After the pandemic, it's really just more of the same work that we were doing before the pandemic started.
Yeah. There was a little bit of a concern that with the pandemic and through 2020 and with the social unrest that we experienced last year, that there was going to be a shift within sustainable investing away from environmental issues to focus more on social issues. And what we've seen over the past, say 18 months, close to it, is the addition of social issues as far as what investors are paying attention to, but not replacing environmental issues. So it's gotten bigger as far as the issues that investors really care about.
Sure. And we'll ask maybe one or two. I'll ask one more audience question. Do you see ESG interplaying with proposed national climate green banks and existing state level climate green banks? Does that question make sense to you?
Not really.
Yeah, we'll skip that one. I have a question that we can maybe wrap up on. Can you tell us about, maybe just in summary, what are some of the greatest strides as a country and as a financial industry that we've made in the last 10 years or so, or since you've been in this space? And what are some things that you would really hope to see and like to see for the future as it comes to the proliferation and perpetuation of ESG sustainable investing?
I would say two or three things. One, corporate attitudes and behavior towards sustainability has improved markedly. 15, 20 years ago, a lot of corporate activities were focused on corporate philanthropy. Typical case is encouraging volunteer days by employees. And over time, companies have begun to really appreciate how ESG issues can be value drivers. And if they are more successful at managing material ESG issues, that can help their long-term sustainability, their long-term ability to create value. So a shifting corporate attitude, I think, is really important. The second point, and then I'll stop, is amongst investors, I think a lot of us are conscientious consumers in that we think about what we spend our money on. certain brands of products, et cetera. We want to buy from respectable companies, responsible companies. And in the past, investments tended to be in a separate silo, totally separate from every other aspect of our life. And what I'm seeing a lot is that wall breaking down between those. So just as I may only buy gasoline from certain companies because I like the brand better, I think they're a better company. So too, I want my investments to be aligned with those decisions. I might be willing to spend an extra nickel for a certain brand of yogurt because I think it's a responsible company. It's treating its workers well. At the same token, I want those types of goals reflected in my investments. So it's all being merged together. It's life. It's not investments and then everything else.
Thank you. Sylvia?
I just piggyback off of what Dan said. I agree with all of that, as well as going back to the Engine 1 proxy battle with ExxonMobil example. I really would like to see boards of directors paying more attention to the ESG proposals that are being filed, because, I said, it's like a New Year's resolution, right? I resolve to go to the gym every week. If I don't, nothing happens to me. These are, they're just signals from the investors that oftentimes, even let's say like on CEO pay, what we've been seeing during the pandemic, CEO pay increased by on average 30% during the pandemic, where median worker pay, according to this recent report by the Economic Policy Institute, fell by 2%. And there's a say on pay resolutions where the voters can say, we don't agree that you deserve this bonus or this raise. But oftentimes it's just one of these things where the boards are like, well, we'll do it anyway. Or they move the goalposts where it could be like performance-based metrics, so whether you get the raise or not, or the bonus. So then time-based metrics, so that, it falls outside of or only halfway through the time frame of the pandemic. And so in order to justify giving the CEO a raise. And so after what happened with Engine 1 and ExxonMobil on climate change, I'd be curious to see another hedge fund, sort of taking other companies to task where there's this really gross distinction between CEO pay and the lowest paid employees, right? And not paying attention to investors, maybe saying you need to not shortchange your workers.
Sure. Well, thank you so much, Sylvia and Dan. It's been a pleasure and honor having you on here, and we really appreciate it.
Thanks for inviting us.
My pleasure. Thank you.
Of course. All right, and for everyone else still on, it looks like we're having an in-person networking event in the Loop in September. We'll aggregate all this information and we'll send out a follow-up email. So thank you so much, everybody. Bye-bye.
Thank you all.
Bye.